In the center of Ankara stands an institution quietly shaping the economic future of an entire nation. It does not build roads or skyscrapers, yet its decisions influence every business, bank, and household across Turkey. This institution is the Central Bank of the Republic of Türkiye, the guardian of the Turkish Lira. Founded in 1930, the bank emerged during the early years of the modern Turkish Republic. At that moment in history, the country needed financial independence and control over its own monetary system. Before the central bank existed, many monetary functions were handled by foreign financial institutions. For a newly formed nation, that dependence created serious economic vulnerability. Establishing a national central bank became a powerful symbol of sovereignty and financial control. In 1931, the Central Bank of Türkiye officially began its operations. From that moment, it became responsible for issuing the country's national currency. The institution gained exclusive authority to print and manage Turkish banknotes. It also became responsible for shaping the nation's monetary policy. One of its most important missions was maintaining price stability. Price stability protects the purchasing power of the country's currency. When inflation rises too quickly, the value of money declines rapidly. Salaries lose value, savings shrink, and economic uncertainty spreads across society. Central banks exist to prevent this dangerous imbalance. They guide the economy mainly through interest rate policies. By adjusting interest rates, central banks influence borrowing, investment, and spending. In Turkey, this task has often been extremely challenging. During the late 20th century, inflation in the country reached extremely high levels. Prices rose quickly, creating pressure on families, businesses, and financial markets. The central bank had to take strict measures to stabilize the currency. Interest rate decisions became a powerful tool to control inflation. Sometimes these policies slowed economic growth in the short term. Balancing growth and stability remains the central challenge of monetary policy. A major turning point came in the early 2000s. In 2001, Turkey experienced one of its worst financial crises. Banks collapsed, markets plunged, and the national economy entered recession. The crisis forced sweeping reforms across the financial system. One key reform strengthened the independence of the central bank. Greater independence allowed policymakers to focus more clearly on inflation control. Similar structures exist in many global central banks. Institutions like the Federal Reserve and the European Central Bank follow similar principles. Turkey adopted a formal inflation-targeting monetary strategy. Interest rates became the primary tool for guiding economic expectations. Over time, these reforms helped stabilize the economy. Inflation gradually decreased compared with earlier decades. Investor confidence slowly returned to Turkish markets. Economic growth accelerated during several years that followed. Yet central banking involves far more than controlling inflation. The institution also manages the country's foreign exchange reserves. These reserves include international currencies and large quantities of gold. They act as a financial safety buffer during global economic shocks. When currency markets become unstable, reserves help defend the national currency. Inside the bank, economists analyze hundreds of economic indicators daily. Data from energy prices, trade flows, employment, and markets feeds into economic models. These models help policymakers understand the direction of the economy. Every interest rate decision requires careful analysis and global awareness. Monetary policy decisions can influence millions of people. The central bank headquarters stands in Ankara, the political capital of Turkey. Its architecture reflects authority, stability, and institutional permanence. Unlike flashy financial towers, its design emphasizes discipline and security. Inside the building, advanced monitoring systems operate continuously. These systems connect Turkey's financial network to global markets. Currency flows, capital movements, and global economic signals are tracked constantly. In today's interconnected economy, central banks must think globally. A financial shock in one region can quickly affect another. That reality makes the role of a central bank more important than ever. Quietly, behind its walls, the Central Bank of Türkiye continues shaping the financial rhythm of the nation.